Look, for those of you who haven't met me, my name's Stephen Earl. I'm obviously with Acuity Capital. I'm based here in New York. I don't know if you can see the Empire State Building behind me, but it's a pretty cool view, which I don't get to see much, but that's okay. Now, actually, so look, we'll get started. This is just some information. I guess the key takeaway from this is obviously what we talk about is confidential in its nature in relation to the at the market or control placement agreement, as well as being indicative. And Acuity is not providing any advice. And lastly, we're an Australian-based company. Despite my being based here in New York, I'm Australian, obviously, and we're an Australian company. And so, look, what we do here is just give a very high level of traditional equity and secondary raisings in particular. So we're not talking about IPOs or anything like that. We're talking about a listed company who needs more money, whether it's because they've got phase 2 testing, whether it's because they're drilling out some sort of project that they think that they might be able to find gold, or it might be a tech company who's just about to sign a deal with Facebook. It doesn't matter. It can be manufacturing, it can be anything. But in essence, what we do with the secondary raising is we go to our instos and say, hey guys, we need $5 million. We need it for these reasons. And that's your private placement to your institutional type investors, your high net worths and whatnot. Then there's to go to your own shareholders. It's to go and do a rights issue, whether it's renounceable, non-renounceable, or what have you. And then there's your share purchase plan. All of these things, I won't go into any detail of them. But of course, happy to talk outside the webinar if someone's interested. And look, this one here is a DRP. It won't really be relevant for the type of audience we're talking about at the moment. DRP is more for your Wesfarmers and those kind of companies. But I think in that category, what I probably should have put is alternative styles of raising capital. But anyway, that's fine. Here is, I guess, the overview of these kinds of things. Obviously, the benefit of raising capital is huge. The benefit is we get money to do something with, and we hope to make more money or return on that money. But broadly speaking, for the company, it can be very expensive. And this obviously includes for shareholders who are going to remain with the company. The timing to get it can be very hard. So if you're going to raise $5 million and your company's worth 30 or 50 or 100, you've got to get that timing right, because obviously if you do raising at 5 cents, it's very different to doing it at 10 cents. And so the timing can be hard. The disclosure documents, depending on what you're doing, so for a rights issue and those kinds of things, typically not required for a placement. SPP booklets are simpler, but you typically need to have some sort of disclosure document. And it is very time consuming for management. They're doing roadshows, they're talking to brokers, they're talking to research analysts, they're talking to investors. It's very, very time consuming. And then once it's actually done, there is no control. The investor invests in the company, takes the stock and says, thanks very much, I'm happy to make X dollars. And who knows, personal circumstances or the circumstances of the investor may mean that they actually decide, wow, I need to get out of this position very quickly. And so there's no control of what actually happens when you place the stock. Obviously, of course, there can be potential for negative reaction, and it can be unfair, it can be inequitable. So if you're doing a placement of $5 million to the insto, and then all the retail shareholders, they don't get to participate, well, they've just been diluted and haven't got the chance to participate at that better price. Of course, there's ways around that. And I think one thing that people don't really talk about, and this is our experience, is being beholden to your broker. Once the broker's done the capital raise for you, then, well, guess what? They want to see you be pushing that company as hard as can. They want research involved. They want all sorts of different things. And I mean this in the nicest possible way. The broker wants to get in as cheap as possible and exit for as much as possible, which makes perfect sense. That's totally fine. But that model means that it can be some friction between the company as well as the broker, because they're goals aren't always 100% aligned. And so what we've sort of said is, what if there's a way for the company to control the capital raising, especially the price and timing, and effectively let everyone participate as well as issue at a better price? That's what we were asking when we came up with Acuity and what we do. So we looked around and said, well, what's the answer? And then what we saw, actually, funnily enough, was what was behind me and where I am. It's New York and the United States. There is a product, and it's called an at the market or an ATM, an at the market or an ATM. It's not a bank machine, but funnily enough, it does provide money in the form of capital, and you issue shares for it. It's called an ATM. And so what we see is an ATM is a secondary stock offering, so the same as a placement or whatnot, except it's only available to US companies, enabling them to sell newly issued shares into the secondary market. So if a shareholder is buying shares in ComSec right now, they're buying off someone who is selling shares. It is not the company who is able to be taking advantage of that on-market price. So if you're about to go into a drilling campaign and you see someone sell shares, well, they're selling it, that's a shareholder selling to another person. And so the company can't be raising at that better price. They've got to go to a broker. They've got to go to the shareholders and ask for a rights issue. With an ATM, the company gets to control. They get to, in effect, dribble out or have a reverse buyback of their own stock. And I'll explain that as we go through. And it's done at prevailing market prices. So if you see it at 10 cents, guess what? The company can issue stock at 10 cents. If it's 20 cents, it's 20 cents. And if the company can say, I don't want to do it for any less than 20 cents, even though there might only be 10 cents. They the same as a sell order. If you put an order in for BHP to say, I want to sell my BHP shares at no less than whatever dollars, so let's call it $40, well, that order will sit there until someone is prepared to buy it for $40. And so very important point. And look, just to give you some flavor for it, these numbers are slightly old now, but 447 companies used ATMs to raise approximately 58 billion between 2012 and 2014. And the market's actually growing. So 30 billion in 2015, and again, around the same number in 2016. So huge, huge numbers. Used by the very, very largest companies, which we're not talking about today, obviously. We're talking about the junior end of the market. That end of the market uses it around news flow. They use it at specific times and often don't use it at all, but have it as part of their toolkit. And so what is it? We call it an ATM. I seem to have lost my, I do apologize for some reason. I've lost the text there. In the center, they were supposed to say ATM CPA, and we were supposed to say it was transparent. It's transparent because the company gets to decide when it happens, what price it happens at, the fees are set, and they control the process. It's opportunistic. Opportunistic in the sense that once an ATM is in place, the company is able to turn it on or off at any time, as many times or not at all through the term. And so let's, for example, say you had an ATM set up with a, excuse me, with a notional limit of say $10 million. The company could say, look, I want to turn it on for this week and I'll put a minimum price of X and I'll take up to $1 million worth. And they can do that 1 time, 10 times, 100 times, 0 times, and whenever they like, So, and importantly, there's no broker. So if you look there, you can see an ATM is not an equity line. It's not a structured finance note. So for those of you who have raised capital before or have talked to, funnily enough, other inverted commas funds from New York, they're often offering an equity line or a con note, a convertible note, or a series of convertible notes, often talked about as a structured finance note. In the literature, unfortunately, those structures are referred to as death spirals. And the spiral is the company going into a death spiral because there's no control over when the stock's hitting when the issuer is actually able to issue the stock and take the cash. Look, I won't run through this slide in a huge amount of detail, but look, basically the ATM market here in the United States is massive. There is huge numbers of companies doing it, all sorts of sectors. The one thing I would say is that when you break this information down, because the market here is so big, they actually take out often companies below 100 million market cap, which is of course the sector we're broadly interested in today, but that's fine. This just gives you some flavor. So you can see healthcare is large, REITs are large, mining makes up a small number there, but funnily enough, all the deals we've done in Australia so far have been with the junior mining sector. So this is just a little table, shows a 4-day period. It looks longer, but it's a 4-day period in August. You can see the kinds of deals they're doing, $30 million notional, $100 million notional. You can see the market caps there. So Rocket Fuel is an example, the top one, $30 million notional, their market cap was $140 million. And so what that's saying is a technology company, you can see the sector there, and all that's saying is that over the next 2 years, they have up to $30 million available under their ATM program. So look, you can see here, this is a breakdown of what ATMs make as part of the actual deal flow. So in terms of the amount of capital raised, there it is there. You can see that capital raisings have been going up each quarter in 2016, but you can also see, or each month rather, and you can also see that the ATMs that form a significant part of that. Importantly, there's the ATM. Importantly, here down the bottom is the structured equity line, or the death spiral that we talked about. So often referred to as a con note or an equity line. Now you can see that they're often also called a lender of last resort. You can see that they are small in number. They're the smallest portion of capital that's raised. Structured equity line, and again, ATMs are not equity lines, and I'll come to a bit more detail on that. So who have used them? I just used the biggest one because it's actually pretty interesting. Bank of America used an ATM in 2009 to raise $13 billion as part of the broader capital management plan. That was just in 11 days. So in 2009, GFC, global financial crisis, Bank of America raised, I think it was $34 billion, it might be 36, $34 billion to shore up their balance sheet, and they used an ATM to do $13 billion of that. So obviously huge numbers. Again, I won't go into this detail. This is a company, again, in the US, obviously, market cap of 45 billion US. And here they're saying, look, we've got this ATM. We've used it to raise $2 billion already in these two previous years, 2013, 2014. And if we need to, we can do an extra billion. This is how long it'll take. This is the same table. I'm just showing here that they're the things and they're the sectors that are using it. So all sorts of sectors using ATMs. Now, how does it work? How can you use an ATM to effectively raise capital? And in particular, what we talked about in the email coming along was how do you raise capital above the VWAP? Well, this here is an example of the timing. So what we've said here is we've entered into an ATM, and at the same time we've requested to exercise the ATM. Now, you don't have to do that, but in this case, we're just for simplicity. And the company has set a floor price. You can see that red dotted line of 20 cents. It said, look, over this period from the 4th of April 2016 to the 17th of April 2016, we're going to turn our ATM on, and anything above 20 cents we'd like to take. And so you can see where it says number 2, the red dots, they're above the 20 cents, and they're also in the red line. So you can see on the, I think it's the 11th of April, the blue dot is below the red line. There's no capital raised at that time. And at the end of the period, so in the gray shaded area, that's the period the ATM is turned on. You can see they're blue dots as well because it's outside the valuation period. And you can see there at number 3, what we would do at number 3 is we would turn around to this company and say, hey, ABC Limited, thanks very much. This is how many shares we're going to subscribe for, so how many you're going to issue. And based on the prices over this period, we're going to give you the market VWAP subject to the floor. And that's how you beat the VWAP. So if you think about the price, everything above 20 cents the company's receiving, and everything below 20 cents the company doesn't care about. So if the share price went down to 15, that doesn't count towards the calculation of the issue price. Only those prices above the VWAP count. So in this case, it's almost touched. It looks like it's touched 25 cents. So some of the prices the company would have got were 20 cents, some were 21, some were 22, and the final price would have been above the 20 cents, obviously, but also above the VWAP because the VWAP went below the floor. And sorry, for those who don't know what VWAP is, it's the value weighted average price over the period. The value weighted average price over the period. So if 1,000 shares traded over the period, and each share traded at $100, then the VWAP would be 10 cents. So, sorry, the total value of shares traded was $100. Sorry, and 1,000 shares traded, the VWAP would be 10 cents. The value weighted average price. Hopefully that makes sense. Hopefully you overfollow. And look, sorry, for those who are putting in questions, I actually can't see them at the moment, but I will get to them at the end if there are. So feel free just to throw some questions in that chat box, and I'll get to them when I can. Here's a real life example of an ATM. I won't name who the company is. This is the actual trajectory I've actually changed the dates and whatnot as well to make it happen in advance. But let's say, for example, that this was going to be the trajectory. And this particular company did a capital raise of $20 million at 65 cents in October 2016. So 65 cents in October 2016. And you can see that's back there. But what, in reality, of course, we don't know what's going to happen in the future. So what the company did is it also entered into and announced an ATM to the ASX for, it might have had a limit of $20 million, $30 million. It doesn't matter, but it would have announced that to the market. And then as time goes by, the company decides, look, I'm actually going to turn the ATM on and I'm going to set a floor price of 90 cents. 90 cents. And so you can see here, that's the floor there at 90 cents. And as time, and anything, below the floor of 90 cents, we miss that. We don't take that into the calculation. And anything, as it says there, and the light blue above the floor, that's the prices that the company takes. That's the prices that the company is able to issue at. So in the same way that if you're a shareholder who's selling shares and you put a price in, if you said, I want to sell my 1,000 shares at 90 cents, well, at 89 cents, nothing happens. But when someone tries to buy at 90 cents, assuming you're at the top of the queue, your order will get filled. Exactly the same concept for the company. Exactly the same concept for the company. But importantly, the company doesn't have to issue, for those of you who are worried about 3Bs and whatnot, the way we structure it means the company doesn't have to keep issuing 3Bs every time something happens. And I can explain that offline if anyone's interested in the detail. And so here time goes on, and here where you can see the price is a little bit hard to see, but the dark weighted blue line, that's the VWAP, so that's the price it's trading at. And then the broken line, the light blue line, that's how many shares are trading in millions each day. So you can see a lot of action going on in this particular stock that's going through the market, and then we're part of that, obviously. And here is where the company is actually able to raise the capital. That's what we're doing. So you can see there, it's taking above the red line, nothing in that now red section below the line. So it's missing all that. So when and if the share price is below the floor, no shares are hedged, and the ATM can be turned off or on at any time. In this particular case, when you compare the price above the line versus the price above and below the line, so you take all the prices, the ATM raise price is 96 cents, 96.32 cents, versus the actual VWAP of 87. So 10% difference, huge differential. And of course, if we go back to the beginning, we saw that the company had already raised $20 million at 65 cents. And no doubt that would be at a discount to the price that was on market. The broker would have said, hey, I need a discount. 10%, 20%, 15%, whatever it might be. Plus the broker would have got a fee of between, anywhere from 4 to 6, 7%, and maybe options, all sorts of different things. So really important. Now, of course, there are exceptions. We see companies do placements at premiums and whatnot, but that's fine. So how does the market react? That's one thing that people get really concerned about. Oh, geez, I'm worried that the market's going to think I'm going to be doing a raise. Well, the reality is that of the 2,200 listed companies on the ASX, the overwhelming majority are come raise. The overwhelming majority don't have enough cash flow, don't pay divs, and they're looking to. They're explorers. They're a junior biotech. They're a junior tech company and whatnot. So these are deals that Acuity's actually done. And what happened to the share price on the day, the next day, 5 days out, and 15 days out? The overwhelming majority are flat or up. It's hard to see on this screen, sorry, but the down ones, so you can see Enterprise Metal, that's down. Genesis Minerals was down eventually, but was up for 2 days. Horseshoe was up the whole way. I'll let you go through that at your own leisure. Importantly, though, one thing that companies do get worried about is, hey, once I tell the market I've got this product, people are going to be worried. Investors are going to worry. Everyone's going to sell. That just doesn't happen. It doesn't happen. We've done enough of these now to say, hey, look, this is either seen as a net positive or no effect at all. So really important point for anyone, for the companies who are listening, as well as for anyone who's advising or talking to companies And look, we get it all the time. We talk to someone at a company, they think it's fantastic. They go back and give the elevator spiel to someone, and someone says, oh, geez, the market's not going to like that. Well, that's not true. They do. So here's a case study. Here's a real deal that we did for a company called Inca Minerals. And Inca Minerals, the code's ICG. Look, there's a bit of detail on this slide, but I won't go through it all. I've compared the way they've raised traditional capital versus when they've used the CPA. Now, importantly, I don't think that they did the wrong thing by doing the traditional. I think that it was important, though, to have the CPA. So having both tools available to them was able to get them the optimal outcome. So when they've entered into the CPA, which was actually prior to this chart, so it was actually in 2014 or perhaps 2015, I need to confirm that, but it was a little while before this happened. You can see the market in general was getting hammered, but they did a rights issue. And actually, funnily enough, I did the rights issue for them. It wasn't with Acuity, it was with someone else who we had a JV with, who I'm sure you're aware of. And we did that rights issue for them, and they were able to raise about $3 million. And shortly thereafter, they did a placement for $1 million at the same price. It was 1 cent, but they did it at a huge discount. They were trading at 1.7, 2 cents before that. So huge discount to get the money in order to enter into a drilling campaign. Unfortunately, as time goes on, you can see that the price has continued to fall, and that drilling campaign ended up finding, funnily enough, a huge porphyry in Peru, but it was too deep to actually monetize it, so it wasn't economical. So they did a couple of more raises. They've ended up issuing 1.2 billion shares. You can see in that column right on the left-hand side under traditional, they raised $6.9 million for an effective price over that period of 5.58 cents. So huge discounts. The average one-day discount was 25, 23%, 22%, and 29%. So huge discounts to market in order to get those away. Now, of course, they needed that money to do things and to do their drilling campaign. So not saying it was a bad decision at all. In fact, it was the right way to do it. But you can see when the market turns around, when the market says, hey, I really like this new project that they're doing, you can see in the blue circles, the blue ovals, they were able to then turn the CPA on. Now, we were only able to raise 2.2 million for them, but you can see that the number of shares issued was 167 million versus 1.24 billion. So we've raised less, sure, and the price we were able to raise it at, with the effective price, was 1.33 cents. 1.33 cents, so more than double what they were able to do. And you can see the average one-day discount was 7%. The average 5-day discount was 11%. But if you take it out to 15 days, we're actually now at a premium. And that's because they turned on their CPA for longer than, say, 5 days or whatever it might be. They got the good prices. So sometimes we did it for them at 1.1, 1.2 because they'd set a floor. Their floor might have been 1 cent, say. And then other times we were able to do it 2.1, 2.2, 2.3 when they had a higher floor and the price had gone up. And so we were able to do those at those better prices. So if you're a shareholder, you're going, that's fantastic. Like, you know, great, you raised capital to continue the drilling campaign. Not only that, I was able just to buy shares on market, and you were able to raise at that market price instead of having to do a huge discount where I was diluted, a huge discount where some of them I didn't get to participate in, and you paid fees, and you did a roadshow, and you had to go and pay for research and all the other things that had to go along with that, took up management's time and whatnot. Whereas the CPA, in this case, what we call a controlled placement agreement, so for smaller companies, it's an ATM, it's exactly the same. It's referred to as a CPA sometimes. That was able to do it, in effect, at a premium, which, again, is for, if you're an existing shareholder there, you're very, very happy with that outcome. Now, some shareholders will never be happy with capital raises. Well, I'd say go and invest in, I don't know what you'd invest in at the moment. Actually, you'd have no capital raise. Everyone's probably, the banks will be next to raise capital. That's my prediction. Anyway, separate issue. So that there shows a comparison. Again, I'm not saying one's better than the other by any means. I'm just simply saying that it's a complementary tool, and in certain circumstances, it will outperform the traditional ones by head and shoulders above. Also, I should mention that at the time that price ran, their broker, who I worked with and know, offered to do them a raise at 0.7 of a cent. 0.7 of a cent. We were able to do it at in that case, 1.2, and then later on at 2.1, which is three times the price that the broker was prepared to do it. And that doesn't include fees either, but from the broker, whereas ours are all inclusive for fees and whatnot. So here's, thankfully coming back to the same slide just to wrap up. So an ATM and at the market, for smaller companies, we call it a controlled placement agreement or CPA. So importantly, control. Control's the number one thing that this particular structure provides. It provides control in the hands of the company, not in investors, not in brokers, and the company can control when and if it's turned on, which provides huge opportunities to take advantage when you've got good news flow or what it might be. Opportunistically raising capital at the best possible time. Minimize dilution and maximize price. It's affordable. If you think about how much a discount is required to raise capital in the current market, anywhere, depending on the size of the company and different factors, but you could easily see a discount of 20% being required in order to get the deal away, plus broker fees. The ATM CPA structure is half that with no broker fees, half that with, at a minimum, half that with no broker fees. So obviously really, really important. And it's transparent. The market price that you see on market is the market price you get. That is really important. So there's no, oh, geez, I wonder how we're going to do this. There's no black magic or anything like that that goes on. If it's trading at 20 cents, and you want to turn on the ATM at 20 cents or better, that's the price you get. If it trades at 23, you're getting 23. If it trades at 19.99 cents, you don't do anything. And then it's unrestricted. So there's no requirement to turn it on. There's no requirement to use it. There's no termination fee. The Acuity ATM or CPA, no fees to terminate, no fees. If you want to do a traditional raise, if you want to do an equity line, if you want to do anything, we do not stop you doing anything. There's no debt covenants, nothing at all, which I think is really important. So again, no roadshows, no prospectuses. It allows you to maximize price and minimize that dilution for your shareholders who want to stick around, not just someone who wants to come in and make a quick buck by selling in and dumping out. That allows you to raise above the VWAP. It allows you to really control it. We see this in the United States all the time, companies being able to raise above that VWAP. And then importantly, like I've said, no broker. So no broker telling you, like, again, I've worked in these firms. I understand how it works. They absolutely have a place and they're absolutely essential for listed companies. But being able to take back some control and being able to actually, determine your own destiny by saying, hey, look, I can raise $1 million on market at this price. In fact, I've just done it. What can you do for me? So it really does give that control back to the company and ultimately the shareholders who want to stay in the company. So look, there's more information available from our website. There's examples, case studies, and a white paper. You can email info@Acuity Capital. There's the Sydney office as well as the New York office is where I'm out of tonight. Beautiful night, by the way, in New York. It's we're almost done now. It's 11 p.m. And look, you can obviously email me with my details as well. So look, what I'll just do very quickly, I'm actually going to be in Australia in June. So very happy to catch up with people then. Feel free to give me a call, shoot me an email. Very happy to do that. We've got a JV with a couple of research analysts as well as a boutique broking house in Australia who looks after high net worths and whatnot. They're very happy to meet as well, talk about what we do. And that's, but for get in touch. And sorry, so that's the end of the actual presentation itself. And so look, back to yours truly, back in New York. And look, so I've seen here some questions. Let me just read through. Over what period does Acuity sell the newly issued shares back into the market? And what are the conditions? Example, only 5% of daily volume. Great question. Thanks, Nick. So the period that we do it is the period the company specifies. So the company says, hey, I want you to go from X date to Y date, and that can be a day, a week, a month, whatever. And that's the date that we do it. So in effect, that gray period that we showed, or the period where the red line is, that's the period that we're actually hedging the position. And so Nick obviously has cottoned on to what we're actually doing. We're hedging that position by selling up to a percentage that's available in the market. Now, in the United States, for very, very large companies, that's roughly 10% of volume. For smaller companies, it's 20%. Now, the reason for smaller companies being 20 is that typically it's turned on during news flow, so you want to take advantage of that. And a trader's rule of thumb is 20% or less, you're just the VWAP. You start to go over 20%, you start to move the VWAP. You start to move it. So hopefully that answers that. Feel free to email me, Nick, or anyone else who wants to go into more detail about how we do that. We've obviously got examples of how we've done it for previous companies. So what are the company's disclosure obligations before and during the process? Good question. You've got to disclose it to the market when you set it up. So Inca Minerals set it up in 2014. They put an announcement out to the market to say, we're commencing this drilling campaign, we're doing X, and we've also got this controlled placement agreement, the at the market, available for up to $3 million over the next, I actually don't think they put an end date on it, but so that was there, an announcement to the market to cleanse the market so the market's aware that you've got the ability to do it. And then after that, the only disclosure that's required is when the shares are issued. So if you think about that period in the gray, what we do is the company requests it, we hedge the position because we're selling through the market, and at the end of the period, we're effectively now short the stock, and because we've sold stock, and we're long cash, and then the company just issues us however many shares we've sold, like a normal exactly like a normal placement, no different. They issue a 3B and a cleansing statement saying, we have just issued 10 million shares to Acuity, or some companies don't tell the market who they're issuing to, they just say to a sophisticated investor, which is us. And they've done that. So a 3B and cleansing statement. So an announcement at the beginning to say it's set up, and then a cleansing statement 3B, like issuing any shares or an option or whatever. So thanks, Catherine. Would the shareholder know if they were buying shares on market or through the ATM, or is the ATM who is the ATM targeted at? So literally the investor or the potential investor who's got an order in the market to buy stock that Acuity is hedging, is selling, they have no idea who they're buying it from. So they have no idea who, where the seller, and they have no idea what if the company's doing that. So on a day, for example, where 100 million shares trades, and the company's asked us to be part of that market, and it's above our floor, then we'll be 20 million shares. But the investor doesn't know if they bought 20 million from us, or typically what will happen is we drip the stock into the market, so we don't have a sell order in the market for 20 million shares. If there's heaps of buying, then we feed that. If there's not much buying, then we hold back. So there's no overhang. Importantly, in the structure, there's no overhang. Acuity is never a forced seller. We never have to sell because we want to protect our own balance sheet. We never have to sell because we need to protect our profitability. So we never need to dump our stock. In fact, quite the opposite. If we raise it 20 cents, we make a percentage of that. But if we do it at 25, we make more money. So we're actually incentivized to do it at a better price. And it's a win-win for the company. Better price means either more capital or less shares issued for them. It means more money for us, more profit for us. So everyone's a winner in the structure. Just another bit of feedback here. So common feedback, So why would a company do this that has heaps of cash? Well, there are certain circumstances where you wouldn't have an ATM. But to give you some idea, things change. Like a lot of cash seems like a lot, and then an opportunity comes available, and you think, wow, that's actually a fantastic opportunity to take advantage of. Or, we see some companies who are already developed their mine, it's in production, they're making money, but they've got all these exploration opportunities, and I don't know what's going to happen to the price of gold. I don't know what's going to happen to iron ore. I don't know what's going to happen in the tech sector. I have no idea. Things can change in a hurry, whether it's good or bad. And so having this tool available, if you're listed, why wouldn't you have an ATM as part of your toolkit? Having it set up, ready, sitting there, ready to go is a prudent as well as smart thing to do, to have that available. And look, just to give you some context, in the US in 2015, when $30 billion was raised, the actual ATM size, the market size in terms of how much was available, was actually 100 billion. So only a third of them were actually used to raise capital. So and a lot of companies had an ATM of 10 million available to them, and either didn't turn it on or just took $1 million, took $2 million. Working cap, price was attractive. Who knows? But the flip side could also be true. The company is going terrible. Everything's just going wrong. Well, it's better to raise a small amount of capital at a bad price than a heap of capital at a bad price. So you can manage through your own cycle. And last question, I'll make this the last one if that's okay, from Pete Taylor. What happens if the share price never goes above that floor? Well, then we never do anything. So in that floor where they set it at 90 cents, all the stuff below the floor we miss, of course. If the share price never went above the 90 cents, well, then we never hedge anything, so we never sell anything. And then if the company, then they don't issue any shares and we don't give them any cash. But of course, it's in the company's control. So the company could have said, we report to them daily and say what we've done. So the company would say, we would say to the company, look, we didn't do anything today. It's below the floor. They'd know that anyway, but we tell them. And then they would say, okay, well, let's keep it as it is. That's fine. Or they could say, okay, drop the floor. Make it 85 cents. Make it 80 cents. But they don't have to. They don't have to at all. And in fact, they could raise the floor if they wanted. They could say, geez, our price is going gangbusters now. We've had a shareholder or a potential shareholder come to us and say, we're happy to do something at $1. All right, great. Well, then put your floor up to $1, take a little bit, and then roll the two together. And we've done that for other companies where we've turned on the structure. They've done that. We've done $500,000 for them, and then they've gone and got another $1 million or $2 million from other shareholders at the same price. And so in effect, you're cornerstoning your own deal. Look, thanks guys very much for coming along to today's webinar. Look, we're going to hold them pretty regularly. There will be a video, the recording of this available. As I said, I'm in Australia in June, or I've gone a little bit over time, so thanks very much for those of you who hung around. And look, any other questions you've got, shoot me an email, get in touch. Get in touch with Belmont Securities or Simon Bilsma from Belmont. And yeah, hopefully we'll see you in the flesh soon. Thanks, guys. Thanks again. See you. Bye.